Most people have no idea that the wealthiest families in history, they didn't keep their money in banks. They became the bank. And once I learned how they did it, I started reading books and learning everything that the wealthy families knew so that I could start doing it. I sat down with Cody Sperber and explained this strategy to him, and his mind was blown. It taught me how to earn uninterrupted compound interest even when I'm spending. How to buy cars, pay off debt, and keep all your money working for you. And how to follow the same principles the Rockefellers and Walt Disney used to build generational wealth. You certainly don't need a master's degree in finance or experience on Wall Street to do this. All it requires is a change in mindset around how you use money. So stick around, smash that like button if you liked it, and also subscribe to this channel. Let's dive in to the podcast.
What we're about to get into is really like what the wealthy do. And the people that get closest to the creation of the money, the people that know how to do this financial engineering with the money, where you're creating money from like nothing, and you're doing it in a really cool tax-free type way a lot of times, it's just brilliant.
Yeah, and what we're going to talk about is something that the richest families in the world have done. The Rothschilds, the Rockefellers, the J.P. Morgans, the Walt Disneys. That's how Walt Disney was started. Ray Kroc, Warren Buffett, and right up to the sitting president. They all use this system, yet nobody seems to know about it because there's just no money in it for people to teach people how to do it.
The infinite banking concept. So let's define for anybody listening to us right now, what is infinite banking?
Yeah, so it's simple. It's a process, okay? So the infinite banking concept is not a product. It's a process of taking back the banking functions in your life. If you look at how a bank operates, all infinite banking is, it's mimicking everything that a bank does, but doing it with your own banking system. So I always tell people, I said, why don't you own a bank? And they always laugh at me and, oh, come on, really? I'm not rolling like that. No. Owning a bank is one thing. You can have a brick and mortar, or performing the daily functions of how a bank operates is a whole different thing, and it's something everybody can do. That's all infinite banking is. It's literally a process of mimicking what a bank does every day, but then it's adding a vehicle, a machine that we're going to run our money through. So literally everything I do involves one change for somebody. Everybody puts their money in a bank to start. That's usually where the money goes first. Yep. And when you do that, you're giving up control of your money to the bank. Look at back in COVID when it hit. If you wanted to take all your money out of the bank would say no. You could only have $4 or $5 grand. You can't take it all. So who's in control? Is it you or the bank? It's the bank. So if you change one thing and you change where your money goes first, that's the best step. So that's what we teach, is we change where the money goes. We put it into a machine that's been around for hundreds of years, the same one.
But Chris, the bank has a building. The bank has an ATM machine. The bank has like people and systems and stuff. I get paid and I want to put it in my own bank.
Yeah.
You get what I'm saying?
I do. So
what is my own bank? Yeah.
So this process, this concept, the infinite banking concept, no, but what the machine is, this is an insurance company. It's not a bank. The Rockefellers and the Rothschilds back in their day, and you could maybe sprinkle in J.P. Morgan, they were bankers, but they didn't trust the banking system. So they had to find a better way to store their capital in a safer place. So they looked around, they found insurance companies. What are the strongest financial institutions then and today? It's not banks. Banks don't even have their own money. They have our money. Insurance companies have all the money. So what they did is they found giant mutually owned insurance companies, and they then had to find a way is how do we get our capital into an insurance company? Because you can't just walk into a giant insurance company and say, hey, I got all this money. Can I deposit it? They'll say, there's the door. Get back out. So they had to create a banking type system using what was available, and what was available back then is the same thing as today. It was a whole life insurance policy. So is the machine.
I've heard whole life insurance policies are like the worst policies to have. What makes this whole, like, I just open up a whole life insurance policy and I'm now a bank?
That'd be a big mistake if you did that. Because I'll agree, just like Dave Ramsey, Susie Orman, they always say, oh, whole life is the worst place to put your money. Right, you are, Dave Ramsey. We're not talking about a regular whole life. So we had to figure this out. We had to figure out how do the banks do this, because the number one purchaser of whole life in the world are traditional banks. Last time I checked, they had $97 billion in whole life, but they don't call it whole life. They call it BOLI. Any one of you can look that up. It's BOLI. Google it, and hundreds of pages come up. So banks put their money in whole life, but do you think the bank is buying the same whole life as you and I would get walking into the insurance store?
Yeah, probably not.
Absolutely not. So we had to find out, what do the banks do to put money into these? And they flip them upside down and design them differently. So when we're talking about a whole life, we're talking about a completely different design of the contract. We actually take the contract of a regular whole life from a specific insurance company and we build it backwards. Most life insurance, or whole life specifically, is for a death benefit. You buy it, you pay a premium, and when you die, somebody gets money.
Yep.
Have you ever met anyone in your life that cares more about the money someone gets the day they die than they do about the money in their bank today? Really? Because I haven't either.
No.
Everybody's like, hey, I'd rather the money in my bank than somebody getting paid the day I die. So they had to reverse engineer. So when we build it, we put the lowest death benefit, the highest cash value, and we do it through special riders in the way that the plans are designed. But a unique thing happens, because a lot of people say, well, great, if that's such a great vehicle to put your money, then how come my advisor never told me to do this? Because the advisor would have to take a 60 to 90% pay cut in order to do this. I was a financial advisor 16 years. Never once in 16 years was I taught about this.
And so this, just note number one, super specialized whole life policies, not a normal whole life policy. Now, can you roll into any financial advisor that is your homie and say, I would like a super specialized whole life policy, please?
You can try.
Are they educated like that? Or is this like, we got to go to a certain place typically to get this?
I don't know if it's a certain place. You got to find somebody that specializes in this. For example, if you had a problem with your heart, would you go to your physician, your general physician, and say, Doc, I need you to operate on my heart. I think it needs to have operation. No, you find the best heart surgeon. So what the companies are and the people like me that do this, we are heart surgeons. We're not generalists. I do nothing else besides this. So we don't sell term insurance. We don't sell IULs. We don't sell regular whole life. We only do banking, and we only design these one different way. And that's the difference. So your advisor might know about it. Try them out. See if they can do it. And then, have us compare it with what an actual design looks like. And you'll find, no, they're totally
So let's
different.
walk a person visualizing this, because we just jumped right in.
We really
and
did.
We're hitting you with some big terms and stuff. And it took me a while to wrap my head around this. First thing I did is I went and looked up how many banks are on their balance sheets have these whole life policies. And me and Kent Clothier, he actually walked me through and showed me, and I went, oh my God, they're buying whole life policies for their people. They're high up people. Yeah. And they're almost like betting on their making money off of their people or something like that. So it's pretty wild how much money they're pouring into these. So walk the normal person that's never heard of this before through the whole cycle, right? Because the ultimate, purpose of all this, if I have my own bank and I'm putting my own money in this whole life, specialized whole life policy, I'm then able to borrow against it.
Yep.
So it comes back to me, and then I can use that in my business to go buy real estate, do flips, do whatever I want, right? And what are the benefits? Walk through the whole cycle so I can get to the benefit moment where everybody goes, oh my gosh, I got to have this.
We're getting the good stuff now. Because everybody right now is like, well, why would I even do that? Like, what's the advantage? Well, the advantage is there's not one other place that you can ever put your money, that you can put your money there, earn a guaranteed interest rate and dividends. And then, so I'll just give you an example. Like I'm using, everybody, I got a $100 bill. So if this was the $100 that I just spent an hour working for, this money's got to go somewhere. Most people would put this in a traditional bank, and the bank might pay you 1%. Let's just pretend it's 1%. If it was one, I know I'm being nice. Any of you have a bank paying you 1%? Probably not. But anyway, I'm being nice. So you put your money there, but then if I take this $100 back out to give to Cody to go buy real estate, does the bank still pay me 1% on that money?
Absolutely
not. This stops the compounding effect. If I change one thing and I take this $100, instead of putting it in a bank, I set up one of these banking systems, and I put this $100 in. And then all of a sudden, 30 days later, you call me up and say, Chris, I got this great deal. You got to get in on this. I'll pay you 12% if you can lend me $100. And folks, the numbers are just numbers.
Yeah.
And then I say, okay, no problem. I then go to my bank, which is a specially designed whole life, and I take this $100 and I give it to you. How much money is still left in my account earning interest and dividends?
I guess $100.
You're right, but most people would say, well, it's the same as a bank. Nothing, because I just took the money out.
Yeah.
But you see, that 100 I just took wasn't even my money. You see, my money is still in my account, earning a guaranteed interest rate plus dividends, which by today's standards is about 6%. Okay, so my money's making 6%, but I just took that money out. Whose money do I have? The insurance company's. The insurance company has all the cash sitting in surplus assets, and they need to move that money the same way you and I need to move it. So the insurance company lends me money from their account and collateralizes it with mine. But when they do that, that loan they gave me, a lot of people are like, oh, that's bad. I don't want another loan. I don't want to pay it back. Great. you don't have to pay it back because what the insurance company gave you was your death benefit early. So while you're living, they leveraged your death benefit and said, hey, we're going to give you $100, but your money stays in here earning uninterrupted compound interest. Well, now I have $100 I can give to you. I can give to any one of the people on this, and they can all go out there and they can use that $100, and then you pay me interest. Here's the difference. A lot of people are like, well, that's cool. I get to earn interest on money that like I'm using.
You're paying yourself interest.
Yep. I'm getting that. Yep. So now I want everybody to visualize. First thing I did is I changed where the money went first. I put it into this specially designed whole life. We're going to call that your private bank. And then I took the money out because the insurance company allowed me to take a loan against my death benefit. Now they charge me interest on that loan. So by today, let's call it 4.25%. I'm making 6. They charge me 4.25. So I'm making a spread. Everybody in real estate understands spreads. So I'm making a spread. I give that money to you. You pay me interest for that loan. And I don't care if it's giving it to you. I don't care if it's paying off a credit card or buying a car, whatever you use your money for, it's the same thing. But I'm going to go one step further because I'm going to treat my money the same way I would treat the bank's money. Now what I got to do is I got to take that money you just gave me and I got to determine where is that interest you're paying me going to go. Most people would just put it right back in the traditional bank. We got to stop giving up control of our money. I'm going to take that interest and I'm going to put that interest back in my bank. So now what I just did is I made money twice instead of once for doing nothing different than changing where my money went. I made the spread, okay, from the money that I'm making from what I'm making and what I'm paying. Then you paid me interest, and I just put that interest back into my bank because I don't want to give them money anymore. The best part is this is where people lose this a little because it's not complicated, but they don't understand compound interest. Everybody's heard the story of if you want $1 million or do you want a penny doubled every day for 30 days? You've heard that, right?
Sure.
The penny doubled every day goes to $5.3 million. But it doesn't get there until like the 27th or 28th day.
Sure.
It's compounding. My money, that $100 and any dollars that I put in there, never stops earning interest. So next year, if my spread was the difference between 6 and 4.2, next year it's more. The year after it's more. The year after it's more. Because it's always compounding, and I don't have to work any harder.
You said it so fast earlier, and I think this is the phrase that everybody needs to get excited over. It's uninterrupted.
Bingo.
Compound interest. Yeah. And now this is why the banks get super uber wealthy. This is what you were saying, like all the wealthiest people, they created this gamification of this system that it's always earning them significant amounts of uninterrupted compound interest.
Correct. Because think about a regular bank. I mean, a bank does this every day. The bank takes money, puts it in the whole life. Then they take that money back out and they pay benefits with it. They pay deferred compensation plans. They invest it, whatever they do with it. But they're always earning interest on that money. But then the one cool thing that happens for the bank, and this is why banks have so many vice presidents. You ever walk into a bank and not see a little tag that says
everybody's a vice president.
Vice president of coffee making, vice president of janitorial. Everybody's a vice president. And nobody ever asks why. Well, it's because in order for an entity, a bank, to buy a specially designed whole life or a BOLI policy, they have to have an insurable body. Well, the bank, being an entity, can't just insure anybody. They have to be able to justify that they have an equitable interest in that person. An executive, VP, is an insurable interest. So now the bank has a mechanism to now buy tons of policies on all their vice presidents, and all they have to give the vice president is a fully paid up life insurance plan. But you think they're giving them the full death benefit? No, Mr. Vice President, here's a $100,000 fully paid up plan, and this is good. As long as you live, we'll pay your spouse or whoever you have as a beneficiary. But when you die, this policy is worth $3 million. So we give $100 to your spouse, we keep the rest. Thanks for playing.
It's so brilliant.
Yeah, it is. It's
so brilliant. Like when you start to think about the financial engineering going on, you're just like, oh my God, no wonder there's a huge wealth gap in the world today.
And it's getting bigger, unfortunately.
This type of knowledge is not taught to anybody. This should be like ninth grade. You should do your financial literacy ninth grade class where they teach you about infinite banking.
Well, I think they should teach you about banking first and teach you the problems with the current banking system and then teach you how to take back control. They never will, though, because you'd crash the banking system. Imagine if everybody knew about this, and it will never happen. Like sometimes I feel like a lone wolf out there because there's so few people that are doing what I do as a sole practice because there's just no money in it.
All right, so how many of these? First off, I set up one. How much money do I got to put in to really get things going?
Great question. So the minimum to do it, because there is a minimum, would be how old are you?
43, about to be 44.
So perfect. I'm 44. So if we take you, 43, multiply that times 10, that's $430. Monthly, that would be your minimum. So your age times 10 is your minimum monthly, and then just multiply it times 12.
So I just want to make sure I understand. Every month, $430 goes into this specialized whole life policy. How long do I got to do that for before I actually can buy a car, borrow against it and buy a car, borrow against it and put it as buy a piece of real estate or whatever I want to do with it? Like, is it put it in 1 month and I'm ready to borrow? Or so, like, how long do I got to let it ride?
Let's just use that $430 because that would be your minimum.
Yeah.
If you went and put $430 in your traditional bank, when can you take that $430 back out?
Whenever.
When your check clears, right?
Yeah.
This is the same. So when you put the money in, your money is available immediately. We always say immediately in the first 30 days because I don't know when your check's going to clear. The downside to this, because there are some negatives, the downside is when you put this money in, if I put 100 in this account, I can't take 100 out. I can take anywhere between 60 and 92% of that out, depending on how we design it, and then I can use that. But the second and the third year and the fourth year, it's more. So now imagine you give up a little bit in the beginning. You put 100 in, you only got to take 90 out. That sucks, right? You lost $10. You didn't lose it, you just didn't have access to it. But the next year, you put another $100 in, but now you can take 101 out. And the year after, you put 100 in, and now you can take 103. And imagine every single year for the rest of your life, every time you made a deposit, more money was able to be taken out than what you put in. There is nothing complicated about this. That is mathematics. Albert Einstein called compound interest the eighth wonder of the world, the most powerful thing in the financial universe. He said, those that understand it earn it, those that don't pay it. What I just explained is exactly that.
I want to buy a car.
Perfect.
Walk me through that. Instead of going down to the car lot and paying cash for a car.
Yes.
Okay, or maybe even going to get a loan and get a car. Show me how I get a car for this. I don't know. I don't know if it'd be free, but it'd be.
Well, you'd get no matter what. Yeah. And I have a little booklet we can give every one of the people watching this for free that shows you how to get all the money back for every single car you ever buy, drive, and own. I've had a lot of nice cars, but I just had a G-Wagon. Get all the money back. It doesn't matter what you pay for the car. You're financing the car yourself, so you're always going to get every penny back on the vehicle. And I've done this for numerous cars. So here's how it works. If you were going to pay cash for a car, you'd have to save that money, right?
Yep.
Same thing here. You'd have to capitalize your bank so you have enough money to buy the car. So what kind of car are we buying?
Let's keep it simple. Yeah, let's keep it simple. Let's just go for, I drive a Tesla. I want to buy a Tesla. They're 110,000, whatever.
So 110. So you would save 110, and most people would. They'd put 110 in a bank or somewhere else, and then they'd go and they'd pay cash for the car by writing a check. Once that money is paid for that car, that money's gone from your family forever, and now you have a car. Tesla's a good one to use because they don't depreciate much, but most cars depreciate. But if we just changed where that money was capitalized and we put it into this machine, now we take the loan out for 110, we give it to Tesla. You still have 110 earning interest. But instead of just paying cash for the car and being like, all right, done, let's pretend that you are the bank and let's treat your money the same as you treat the bank's money. So if you were to finance that car through Tesla, what do you think the payment would be? $1,500?
Yeah, $1,500.
$1,600. Yeah, 15. We'll do $1,500. It's easy math. Yeah. So if you would have given $1,500 a month to Tesla, if you leased or financed the car, and you just paid cash for the car by taking a loan from your bank, why not then pay your bank back $1,500 every month? Now, it doesn't make a difference. People are like, well, why would I ever, make payments on a car that I just saved up and paid cash for? Well, here's why. You keep all the $1,500. So all we do is we set up a bill pay for $1,500, the exact amount you would have gave away, and we put that back in your account. So now every month, $1,500 is going back in the same duration, 5 years or whatever duration Tesla would have given you. At the end of the 5th year, all the money plus all the interest you would have given away to Tesla is in your account, plus all the uninterrupted compound interest you earned, which is significant. You would get every penny back for every car you ever buy, drive, and own.
Yeah, you'd make money.
Oh, you'd make a lot of money.
Because of the uninterrupted compound interest.
That G-Wagon, I only kept it for about a year and a half because they're so high. I just sold it.
Yeah.
And I ended up pocketing, with the interest and everything, almost $20,000 on a car that I drove for free because of this.
I love this. Mm-hmm. People that are catching on to what we're doing right here, this financial engineering, they're like, oh, yeah, I want to set one of these up. Yeah. All right. Now, next question. Do I want just one and put all my money into it, or do I want multiple ones? Is there any benefit of is it just one? You set one up and you run and gun it.
I have 9. Okay, so it's not because I want 9. I started this a long time ago. My first policy was taken out in 2003. And when I did that, in 2003, I didn't have the money I do today. So I started with $230 a month, and I did that. And then when I had more money than $230, I couldn't just put it in that same one. So here's the thing. So let's just use that $10,000 example, okay? Just simple math. You start a policy and you put $10,000 a year or $1,000 a month, whatever way you want to do it.
Yeah.
That policy cannot ever take any more than $10,000. So you can't come in the next year because you sold the property and you're like, oh, I want to put $15,000 in. No, 10 is your max because of IRS rules. You can go down, but you can never go up. So I can reduce the amount I'm putting in down to $4,000, but I can't go higher than 10. So now all of a sudden you have a good year the next year. And you're like, damn, this thing's so great. I want to put more than 10 in. You start your second banking policy. It's kind of think of them like a bank.
Yeah.
There's a bank on every single branch of every city and every single state in this country. You're never going to just have one of these. Not because you want more, but because you're going to want to put more and more of your capital through this system.
So got it. So if I want to step my game up, I got to start a whole new one.
Yes.
Now, about how much does it cost to set one of these up?
So the annual fee for these policies is between $50 or $100 a year. That would be your policy service fee. We don't charge for setting them up. We're paid directly by the insurance company. Every $10,000 you put into the policy, I and my company would make about $437 in commission. That's it.
Dude, this is what a win.
Yeah.
What a win for you. But
if it was a regular whole life policy, you want to know how much money the person would make? $5,500 to $9,000.
Yeah, so that's why they're pitching whole life to you. Just get whole life. They don't even want to talk about this.
IULs are even worse. They're the worst.
What is it?
IUL, Indexed Universal Life. That every broker on the street
what is that?
sells. It's a new manufactured product called an Indexed Universal Life. They're meant to basically be a permanent plan like a whole life, but they give you upside of the market, so you can put money in.
Got it.
The insurance company lets you participate in the gains in the indexing, the index fund that they do. So those products will pay every 10 grand you put in between $9,000 and $12,000 in commission. So that's
so
why
you're saying those are horrible.
Well, think about it. If the advisor makes $12,000 and you just put 10 in, who loses? I mean, come on. It's just money can't just be created. So if they're making a big commission, you have less money. The plan I said, if you put 10 in and I get paid $437, the reason you have immediate access to your money is because I gave up my commission. Somebody has to give for somebody else to get. It's the universal law.
All right, what's the big downside? How do I fuck this up? Like, how do I literally, like, is it choosing the wrong setup? Is it I have a hard couple months and I just stop putting money into it and there's a penalty? Like, what's the pain?
So the pain would be this. First pain we already talked about. You put 10 grand in, you only have 9 you can use. Okay, so that's the first year. First year is the worst year. You know, you're going to be at a loss the first year, sometimes even the second year. But after that, it's gravy train. So that's a downside. Second downside is if you're not healthy, you're not going to get issued this. Okay, because you have to go through a medical underwriting. So you could get denied, and then you got to borrow a life, like a brother, a spouse, a child, whatever. But
third party whole life, specialized whole life policy.
Think about a bank, right? Banks buying policies on executives.
You just go to your brother and you pin him with the VP of Cody Sperber Company. Yeah. Hey, you're in.
That's it. Just
I'm buying you a policy.
VP and buy a policy on them because you can own it and they're just the insured and you control it with ownership. So those are some bad sides. Another downside would be is you start a plan for 10 grand. The second year, you decide you're not going to put any money in. The plan would never make it. But remember, you have the ability to fluctuate. So if you started at 10, next year you have a bad year, you can reduce it down to 4, no problem. You can actually probably go to 3. So we build about 65% into the plan so that you can fluctuate down.
Okay. Now you said you can go down, but you can't go up. But I can go back up to the 10.
Absolutely.
I just
and
can't
you
ever
could make up what you didn't put in.
Okay,
right.
got it. Yeah. So it's just that's the cap.
But even if you did that, like that's not such a bad thing because if you put 10 in and you next year didn't want to, I mean, you pretty much would have gotten all your money back. I mean, there'd be very little that you would leave on the table for doing that, but that's still a downside. I'm trying to think of how else you can.
Is there any limitations on what I can use this money for?
No, none.
It's my money.
Yep. And all that internal compounding is all internally tax-free.
Okay, so what if I borrow against it? I buy the Tesla. I'm making my $1,500 a month payments. Then I have a hard time, and I'm like, it's my own car. It's my own payments to myself. I just can skip a few?
Yeah. So here's what happened. Let's say you set up that arrangement, $1,500, and you're being really good about it, and then, I don't know, something happens, and your mind goes back to the old way of thinking, like, why am I doing this? And then you just, basically, here's how you got to look at it. It's your bank. You're now stealing from your bank. How long are you going to steal from your bank before your bank no longer is a Sullivan bank? So if you hit hard times, this happens all the time, just so you know. When I was doing this a long time ago with a flip, I got into one flip, and I lent the money from my policy. It was a nightmare. Everything bad happened. Asbestos remediation, you've had them, right? Where you think it's an easy one, then all of a sudden 2 years later, you're like, when is this thing going to be done? It was the worst flip I've ever done. My money was from my policy. For almost 2 years, I couldn't pay my policy back anything. Just didn't have the cash flow. So what I did is I had to go to the mirror. So everyone watching has a mirror. Mm-hmm. Go to the mirror and look in the mirror sad and just say, listen, fell in some hard times. I need to skip a couple payments? Can I skip a few payments? And in the reflection is you looking back saying, yeah, no problem. It's your bank. It's your rules. It's your terms. But, again, just always remember, if you owned a grocery store, you wouldn't steal the peas out the back door every day. Your grocery store would go out of business. Yeah. There's not a business in the world that if you steal from it, it will still remain in business.
I love this concept. When you first modeled this out at our mastermind, I mean, this is $1 million worth of game right here.
Oh yeah.
Yeah. This is, and it's a little high level, and I know it's a lot to take in. I want everybody listening to this to digest what you're saying, what you're hearing, and try to make a decision like, am I ready to start my first one? It doesn't have to be super big, right? Like you said, you can put in your age times 10 per month. Right? And so if you can visualize yourself being able to do that, you should probably do this. And
here's the most important thing. So too many people, they understand whole life and like, okay, that sounds cool. But remember, that's not where we're going to make our money. We're going to make our money by putting the money here and then making our money go out and work for us. So your money working for you is where you're going to become wealthy. It's not putting your money in a stupid whole life like what I'm talking about. That's just the machine. And if you just use just the machine to hold money and you never do anything with it, well, you're making 6%. Whip-de-freaking-do. The money's made because I can put it in, take it out, and go invest it or go do all the things I do that I usually would borrow money from the bank and do that. For example, a lot of people have credit card debt. Imagine how much money you pay on a Visa, right? 20, 29%. What if I put money into this account, I took the loan, I paid off Visa, and I took the exact amount I gave Visa every month, and then when Visa's gone, I just pay it back to my policy. That's the equivalent of making whatever return you were paying to Visa, 20, 29%. That's where people start. Most people, when they start with us, they'll come to us for various reasons. Like, people we know from the mastermind come to us for, they want to invest it. Yeah. They're like, well, I got all this money in the bank. Can I just dump this money into here? Sure. And then can I just take that money right back out? Sure. And can I just give it to Cody? Well, you should just give it to Cody is what I always tell them. I'm just kidding. But you can use this for anything. But if we're already leaking money, if your boat's already leaking, we have to start there. If you're giving money away to credit cards, if you're giving money away to loans, let's take that money back that you're giving away and then capture that. Then we'll redeploy that money out to make it work harder. That's where you make all your money, is what the money does for you.
Got it. So solve the leaks first, then start investing and stepping your game up. Maybe get a free car. Next
get the car.
Stop the credit card payments, then get the free car, and then start investing.
Absolutely.
What's the tax benefit of doing all it? It's a loan, right? So you're not being when does you get hit with the taxes?
So on the money, so if I lent you money, that 12% you pay me, that's going to be taxed. But everything my policy makes for the rest of my life is all tax-free, as long as I don't lapse the policy. If you lapse it, you're paying tax on all of it.
Got it.
Always remains tax-free. Not only tax-free, it's protected against judgments in liens. So if you got sued, somebody slips and falls at your rental, they can't go after this money. Your kid's going to go to college and you want to fill out FAFSA forms so that they can get student or financial aid.
Yeah.
These assets, you could have $10 million in this, and it cannot be counted. There's so many loopholes that they've written into the tax code. Because like I said, who's the one that created this? The wealthiest families.
Yep.
Who did the tax code? Well, the Fed was created at the same time as the tax code, so you can figure that out. 1913, the two were created. Well, those are the people using this. So they never will take these advantages away because this is where the wealthiest individuals keep their cash.
I love it. And for this particular Clever Investor Show episode, we have our mentoring students listening in, where they're being a fly on the wall, which I love to do it this way. It's just kind of fun. I'm looking at the comments, man. All of them are like, I want to do it. Take my money. Let's go. How do I start? So just to get right to it, and then I want to talk about some non-real estate stuff for a minute, because I think you have a lot of experience and can probably drop some awesome wisdom on some people.
I can try.
Where would they go to actually do this?
So it's easy. So there is a toll to basically have a call with me, and you have to watch a 90-minute video. And that goes back to when I learned about this. So what you do, you go to chrisnaugle.com, Naugle, and then a pop-up will come up to watch a 90-minute video. After you watch that 90-minute video, book a call, and I'll answer every question, or my team will answer every question that you have. And if it's the right thing, we don't ever have to sell this, because if it works to solve your problems, then you can ask us to do business, and then we'll help design it.
I love these kind of conversations. Appreciate you. I want to get my specialized whole life policy up and going, and we probably should do something for our students, like a real webinar or something like that, because I think every single person should set one of these up and become their own bank. Infinite banking is so cool, and you're definitely the man to go to learn more about it.
I'd be happy to help.
I hope that conversation got you thinking about money differently, because once you understand how being your own bank works, everything changes. See you next time.